Good morning and welcome to the BF Anderson Market Report, Technical Report for March 22nd. I have here a graph of the S&P 500 index as of yesterday, going back 12 months. Going back to 2009. And what I'm trying to show here is how simple and easy it is to draw a trend line. So what you do is you take your low and then you connect all the lows as you go through time. It's incredibly simple to do. So what you notice here is that when you're in an uptrend, that is a bull market. Now, as I'm showing here in this box, we went through a very, very difficult period from around 2014 up until the election of 2016. We were locked in a pretty much a trendless market with a lot of drops. In other words, drop sideways, drop sideways, drop sideways. So this really would challenge the average investor on a day-to-day basis because this was such a long, drawn-out, difficult period. But if you hung in there, you basically have now experienced a new uptrend that what I'm actually saying is a new bull market or a growth stock cycle. So what I did is I went back in time and I said, okay, let's look at other uptrends. So I went back to 1984 to 2000, which was a uptrend, and then I went to 1954 to 1972, which was an uptrend. Now, this uptrend from 1984, which was point A, till the spring of 2000, which is point B, was an increase of 822%, so roughly 8 times your money. The uptrend lasted 3,873 days, of which 2,105 of those days were up days, 1,761 days were down days, or roughly 50-50, 54% up days, 46% down days. Here's where it even gets more interesting. The average up day was an increase of 0.68%, or roughly 0.7%, and down days were a minus 0.67, or roughly minus 0.7. Now, there were 7 flat days in this time period. So this is a very deceptive situation, because if you're watching your portfolio on a day-by-day basis, it almost becomes counterproductive. Now, everybody does it, including myself, where we watch our stocks and our portfolio every single day. But what I'm arguing for is that if you want to get from point A to point B, I think it's much more important to understand the trend line, and if you could just watch the trend line, it would eliminate a lot of short-term fears that could really hurt your results. So what I'm saying is that on a day-by-day basis, you're going to have down periods, you're going to have up periods. But if the trend remains up, leave it alone. So here, for example, just to kind of understand these things, this is the low that where we broke out in 84, crash of 87. Now this was a tough one here. More than likely would have been taking defensive action in here, but you stayed in the market. You stayed with it. Again, tough period here. Now, I would say probably one of the biggest problems that we have is that we'll get into these time periods where you get a lot of white space, where there's a lot of movement above the trend line, and then you pull back to it. But usually this is indication of a very strong bull market, and this was a very strong period. So again, if we take it day by day, which makes more sense, and what I have now is the S&P 500, as of the last 12 months, including yesterday, what is going on with the trend as far as daily trends? Well, if you look at the 30-day trend, the 40-day trend, or the 50-day moving average, which I call trend, it takes out all the noise. And so you could look here and you say, gosh, this looks like a bull market to me. I should continue to build my portfolio here. This is a very healthy looking market. Now, we don't want to get caught up in understanding only uptrends. We also want to understand downtrends. And so I call it buy and hold, hope and pray. So in other words, take this as General Electric. The company has gotten into trouble. There's no doubt about it. They're having all kinds of problems. You can see that, going back 2 years, that you had a real sideways no trend situation. Then you started breaking into a downtrend. You really have to take defensive action on something like this, and there's you've got to use a stop loss. So as we get into the top 5, here's W.W. Grainger. Again, the industrial stocks are looking good. This is a very nice uptrend. You can see some volatility in here, but W.W. Grainger is in the top 5, which is a watch list, not a buy list, and looks good. Now here is a technology stock, Micron Tech. Now we're getting back into the semiconductors, and when the semiconductors are strong, that's a really good indication that economic conditions are improving. Now, here is an interesting situation. Last week we talked about the enterprise software stocks, the software platforms. Here's a company called MuleSoft. It's been on our list. Did not make top 5 until this week because they're getting bought out by Salesforce.com. So what's happening here is in these software stocks, not only are we seeing the positive activity in the marketplace in software stocks, but so is Salesforce.com because they're buying this company, and you can see what it did to the stock price. It jumped dramatically. Again, Netflix continues to make the list. This is another software platform, continues to be in a strong uptrend. We are seeing a little bit of a pullback in here. Not too concerned about it, but we are watching it. Now, Twitter continues to make the list. Now, the problem here for Twitter this week has been the Facebook fiasco, and it's pulling down all the social networking stocks. So in conclusion, what I'm trying to argue for here is to understand the importance of trend following versus day-to-day volatility. The volatility will cause you to be shooken out at the worst possible time. If you have any questions, give me a call. Thank you.